last week in the second session we started to discuss the subject matters, but still this is a basic introduction in which we discuss what is the role of bank and what's within the bank, what's the role of treasury in a very broader perspective. So where we stop the class is at what is the role of the central bank. So we discuss about liquidity. Any questions up to that point before I move into this? If you have any questions, please ask. If not, I'll continue with this. We discuss about liquidity. Basically, what we mean by liquidity is borrower's ability to pay. So not only borrower. So your institution should be able to meet your obligation. That's the liquidity of the institution. This is very important for any bank. So main focus of the treasury would be to maintain the liquidity. Whenever you are short in liquidity, that means you need some funds. What do? You borrow it from another bank. You can do that. To borrow from another bank, other banks in the system should have excess money. If they are also in a short position, they cannot lend to someone else. So therefore, individually, when each and every bank look after their own liquidity position, as a system, what is the liquidity position? Or in other words, what's the amount of excess funds available within the banking system for a particular day? We call it the system liquidity, or the liquidity of the market, in the market. That is assessed by the central bank. However, it's not the only role placed by the central bank. Central bank is the regulator, you know, all those things. So, but from the liquidity side, central bank plays a role there. So whether banks remain liquid or not. If there's any liquidity problem of a particular bank or the system as a whole, central bank takes some actions. So the rest of this presentation discusses that. So we'll go through that. Role of the central bank, as I mentioned, it's not limited to liquidity problems. It controls money supply. That means what is the amount of money available in the system. And remember, there's a difference between cash and money. Cash is whatever we have, coins and notes in physical form. But money is not like that. You will realize the difference in short while. What is money supply? Money supply, there are different definitions, but in Sri Lanka, we broadly use that broad money supply, or the M2. I'm not going to discuss in detail what is money supply and the definition, but broadly, money supply M2B, broad money, is defined as currency held by the public. So individually, you and me and other people in the country, we hold cash and cash. That means currency notes and coins. That is the basic category of money. Then we maintain demand deposits or time deposits, saving deposits with commercial banks. All those together, we call it as broad money, or the broad money supply. So now you might recognize there's a difference between cash and money, small difference. When you place 100 rupees deposit with a bank, you have to give a 100 rupee note. Then it will register in the books of the bank as there's a deposit. But that currency note, 100 rupee note, will not remain within the bank. It may go out to another customer whenever he takes the or customer does a withdrawal. Not only that, bank can lend money. So therefore there's a difference between cash and money. We'll discuss that. So this is the broader definition of money supply. I'll show you within the central bank annual report. There's a separate section and a table where you can find different definitions and the amounts of money supply statistic. We'll go into that later. However, I'll explain here what would happen if a customer deposit 100 units. So this is a cash note. Deposit it with a bank. Then what would happen? So here we assume for each 100 rupee deposit, which bank takes as a deposit, 10% has to allocate for reserve. You might know that there's a thing called statutory reserve requirement. That is a percentage, as a percentage of deposit, bank has to place some percentage with the central bank. You cannot use it. The bank cannot use it for lending or any other activity. This is allocated as a reserve. Here for simplicity, we assume it is as 10%. So whenever bank takes 100 rupees or 100 units, whatever currency, rupees or dollars or taka or whatever, 100 units, they have to allocate 10% or 10 units as reserves. Then the bank has another 90 units available, 90% available. What does bank do with this remaining part is lending. The bank can lend 90 units. What would the borrower do? He may spend it, or it may initially transfer to another bank account, or even he spends it, ultimately it will come to a bank, maybe one bank or few banks in different ways. So out of that 90, assume that 90 goes into the bank, another bank, or maybe the same bank. Again, out of that 90, the second bank has to allocate a reserve. So 10% of 90, that means 90 units. Likewise, then the second bank has left only with 81 units to lend. They can lend 81 units. That may come to another bank or the same bank again. The third bank can lend only 10% of 81 units. Sorry. The third bank has to keep a reserve of 8.1 units. That is 10% of the amount that they received. Likewise, this process goes on. But only single 100 note, with a single 100 note, what is the amount of money created? Because there's a deposit of 100 here. And there's a 10 unit reserve, 90 loan. But in the second bank, there's another 90 rupee deposit, out of which is 9 is allocated to reserve, another 81 is lent out. If you take only these first two banks, after this, what is the amount of money available in the system? There's 100 deposit, 90 loan out, 190, 81, this 9 units. Likewise, it will be add-on. So this is the process we call money creation. 1 rupee issued by the central bank will create more money in the system through this banking system. That is we call money creation process. So in this example, if you work out, at the end there should be 170 units of money loan. With 100 rupees, started with 100 rupee, just after this cycle, 2 steps go forward, you get 170 units of money. So this is money creation. This is the process of money creation. I hope you know these things, because you work for banks and some of you have learned about banking. Is it clear? Any question so far?
Yes, sir.
One thing I can hear only few are speaking or responding to my questions, answering my questions or asking questions. Others, so here, if it is a physical class, you have whenever you ask a question, others can see you. You may be you don't want to highlight like that. So now, but in this online class, you don't face that problem. Don't be shy. Ask question, because even though others, they don't ask question, even they don't know the answer. They are not clear about what I talk about. So better, if you are not clear, don't worry about others. Others will definitely, they will benefit through your question. So please ask if you have any questions. Don't be shy, because ultimately, if if you don't go through the exam, that will be the worst case. So don't worry to ask questions now rather than failing at the exam. So I encourage or ask you to ask questions as many. It will help you and others in the class to get better understanding about the subject. So everybody will behave like, okay, it's clear for me, I know that, but it's not the case. I'm pretty sure it's not the case. Only other thing is that disadvantage I see in this method. If you were sitting in the physical class, I can see your faces, I can see your notes, how do you work out things, I can pinpoint and ask questions, then I can see whether you have understood or not. But in this, I don't have that luxury. So I am facing a problem there. Whether to understand whether you have understood the subject or not. There's no way for me to get that unless you speak out. So please ask questions. Please respond to my questions.
Mr.
Hello.
Nish.
Sir,
Yes.
Yes.
Small concern. You have explained the
Yes,
money
Mr.
creation
Nishant there?
process. Hello.
Yes, go ahead.
Hello.
If you can tell your name,
I'm Sagar.
Yes, Sagar. Go ahead.
Mr. Nishant.
Sir, I'm Sagar here.
Sorry, first let Sagar go ahead first. Yes,
as I previously learned, the money creation is done by the commercial banks.
Yes.
Right. The process you explain now is also done by the specialized bank and licensed specialized finance companies also. So can't they create the money? And another concern is the specialized bank need the keep the statutory reserve requirement. As I know, only commercial banks keep the statutory SRR.
Only commercial banks, yes. That's a concern.
Yeah.
Yes, true.
Yeah.
This can happen through the
Then can licensed specialized bank create money?
Can they take deposits?
They can take the deposit, they can lending.
Yes, they can take deposit, they can lend.
They take the deposit.
Then this will happen, yes.
Yeah. But as I previously learned, only commercial banks can create the money.
That's what like theory says. Because that's the major concern. Money creation through commercial banks, because they are the only one who can maintain demand deposits for the what do you call current accounts. That's the origination of this theory. But yes, I accept there's something now we have to change the way we look at this problem. It's with the development of financial markets and the institutions. It's not only commercial banks. You are correct. Others also create money.
Yeah. Okay.
Yes, Mr. Nishant, this is regarding that 10% reserve. This 10% SRR is available with the central bank monetary tool for a longer period. The basic idea of this, whether to maintain the use as a money market control tool, or to improve the liquidity of the bank as a safeguard the deposits.
It's both.
What is the purpose of keeping 10% each deposit with the central bank?
Yeah, I would say both, but it is very difficult to safeguard deposits with the 10%. It's not enough. That's why we have created a deposit insurance as well. It's not enough, but main purpose is to control money supply. So what we discuss here, money supply. Why? So if you take 100 unit deposit, when you take 10 units, you can create only 90 units as loan. So the money growth is like that. But what would happen if you increase this 10% deposits to 50%? You can loan out only 50. Then the money creation will be less. On the other side, if we decrease that 10% to, as now in Sri Lankan condition, to 2%, you can loan out more. Funds available within the system to generate credit will be increased when this reserve requirement is low. Money supply will be reduced when the requirement increase. Basically, we use central banks use this as a tool to control money supply. We will discuss this in a few slides. So you can see here, it's one of the instrument or a tool which we use, central bank uses to control the money supply. You can save to safeguard deposits, but this is not enough to do that. It's not the main purpose. Main purpose is
Hello, sir.
control fund supply. Yes.
I have a small question. For the liquidity support purpose, can we request money from our reserve? Get any
No.
money?
No. You,
Okay,
you,
that
you
mean
can't,
that
you
is
can't take,
okay. That means central bank is using it as to control the money supply.
yes.
Okay, thank you, sir.
So
That's
what is the consequences of money creation?
money creation, the inflation. Ultimate consequence is inflation, because when there are a lot of money in the market available, people will demand. If the supply is not there, prices will go up, and it will create inflationary situation in the economy. That may create asset bubbles. Clear?
How do we control that in the market?
What? Money creation.
Yes, money creation.
So that's why this is one of the way. So when the central bank increases reserve requirement, available of funds for banks will decrease. So there's less room for them to generate loans.
Well, sir, does central bank use open market operations to regulate these inflation?
That's another tool. Yes.
Right.
This is sort of long term.
Right.
Generally, what do you do? But daily, as I mentioned, so we'll come to that. Daily central bank measures what is the liquidity in the system, banking system. What is the liquidity? So as I mentioned, so we have say 20 odd banks. Not each and every bank has surplus every day. What do you mean by surplus? Once you meet your obligation, when you meet that reserve requirement, and after lending, do you have any excess cash with you? That is excess funds. When you have excess funds, what do? You lend it. Correct? But meantime, there may be some other banks, you don't have sufficient fund today to meet your SRR. Whatever the SRR requirement, there may be banks, they are not in a position to meet that. What do? They borrow from another bank. So as a whole, there may be some banks which has surplus and some banks with deficits. When we net all those amount, then we can see what is the liquidity position of the banking system. Once deficit units borrowed from surplus units, if there's still excess funds, then the market is liquid, or market is in a excess liquidity situation. If there's a deficit, then the whole market is in a deficit situation. Even the banks lend and borrow among themselves, it is not enough to cover the requirement of all banks. So central bank, domestic operations department of the central bank assess this daily. What is the market liquidity? Because they know, they have information about bank balances. They assess the liquidity requirement. Accordingly, they conduct OMO auctions. If they think this, or they find out the market is having excess liquidity, then domestic operation department will conduct an auction to take out that excess funds from the system into the central bank. If the market is in a deficit situation, then central bank will conduct OMO auction to pump liquidity into the system. Clear?
Yes, Ms. Nishanta. Then, as per the recent actions which have taken by the central bank to improve the market
Sorry.
Yes, to improve the liquidity in the market, that central bank has taken several actions recent past. The one of is that the release relax that SLAR condition that up to 20%. Why central bank choose that action without taking to relax the SRR?
Why not? It's now at 2%. It was 10% or 8% earlier.
SRR is now 2%.
Now 2%. Yes.
Okay, right. Thank you.
Any other question?
Hello.
Yes.
Yeah, just small questions. Can I see the market liquidity position in? Are there any reports in the central bank side?
Market liquidity position in the?
Yeah. Are there any reports to find out in the central bank side?
Central bank site
Website?
No. Not the current question. Maybe something.
Maybe historical report. Maybe
historical. Yes. How it behaves as like this is from the annual report 2019. 2021 is not yet released. So page 255, you can find this table 7.4. You can find this information. Monetary aggregates, money supply figures. What were the figures as at end of 2019 December? You will find currency outstanding, reserve money. So different money supply measures, but broadly, ultimately as a tool, we central bank monitors this M2B money supply.
Okay, so thank you very much.
So, as I mentioned, there are few measures of money supply, and the definitions may vary from slightly from one country to another, but broadly the same. M2B is the widely used one in Sri Lanka, but reserve money also we looked at. So, as I mentioned, this is the place where you can find out this information in the annual report. I'm not sure whether any economic weekly, we release weekly economic indicators. You may find some figures related to that in the weekly economic indicators release. So, as one of you asked, what would happen if money supply increases or decreases? So, there will be a direct impact on inflation, economic growth, balance of payments, and the exchange rate. As I mentioned earlier, what would happen if there's a lot of money available in the system? Few things. When the supply is huge, what would happen to the demand? Oh, no, sorry, not the demand, price. Price will go down. What is the price of money?
Interest.
Price of money is interest. So when there's a increase in money supply, interest rate should go down. What would happen when the interest rate goes down? What do you do these days when the interest rate is low? You borrow.
Deposit.
When the interest rate is low, what do you do? Make a deposit or borrow?
Borrow more.
Deposit and more lending.
Sorry? As a bank, yes. As a bank, you may have to lend because customers are asking more funds and they want to borrow. Basically, as individual or economic agents in the economy, people will borrow. And what do they do with borrowed funds?
They engage in different activities,
What sort of activities?
maybe a business.
They may invest in a new business. Yes. Then
Consumption.
they may
Consumption purpose.
Yes. It may consumption purposes. It may be necessities like food and medicine or things like that, or it may be some other
Housing construction.
maybe housing constructions, or they may buy land, they may start a
License.
house, or maybe buy a vehicle or luxury items for the house or your consumption, things like that. When that
Some
happens,
people invest in different units like stock market like that.
yes, that can happen. When the if the borrower invest in stock market or start a new business, that will help for the economic growth. They will produce new thing, so that will help to economic growth. But what would happen if the consumption increases?
No economic gain there.
Demand will increase.
Demand will increase. When the demand goes up, still with the same supply, what would happen?
Prices.
Prices in the market will go up.
Right? Prices will go up. That will
Prices will go up.
that will generate inflation. What would happen to imports? People will demand more goods and services. We are not in a position to meet that demand. Prices are going up. So the easiest way to import it, because to manufacture those things within the domestic environment, it will take time. So you cannot expand your business overnight, most of the things. So to fill the gap, we will import. Then what would happen to the balance of payments?
Deficit.
It will be deteriorate. It may be decreased, balance of payments decrease. If it goes to negative, deficit. In our situation, deficit will widen because most of the time we have a POP deficit. Then what would happen to the exchange rate and interest rates? As we discussed, when the money supply is increasing, interest rate goes down. Interest rate goes down, balance of payments is at a deficit, then what would happen to the exchange rate?
Exchange rates will go up.
Exchange rate will go up. That means that in Sri Lankan context, yes, exchange rate will go up and the rupee will depreciate. That is the consequences of increase in money supply. So all those things will be reversed if money supply decreases. So that's why central bank controls this money supply and take actions to control the money supply. While monitoring money supply and the liquidity position of the system, take actions to control it. So to control that, central bank uses three main tools. First one is the SRR. As I explained earlier, out of 100 rupee deposit that a bank takes, what is the percentage the bank has to kept with the central bank as a reserve? That is we call SRR. Now currently in Sri Lanka it is 2%. And there's another one called bank rate. Bank rate is the as a lender of last resort. That means if any particular bank faces a liquidity situation, liquidity problem, there's no other way to borrow it for that bank to borrow from other banks in the system. There's no way to liquidate their asset quickly, and they might face liquidity problem. So in that scenario, that bank can come to the central bank and ask for money. It's like bailout, or provide liquidity support for the bank. It will be done only if the bank is having a liquidity problem. The bank balance sheet is sound, good. They can maintain the business. Their assets are in very good shape, good quality assets. So in that case, only central bank will intervene and give liquidity support just to survive today. Once you survive today with your other cash flows and other assets, the bank can carry on the business. If the central bank has that confidence, central bank will provide liquidity for a particular bank as the lender of last resort. What is the interest rate charged for that is the bank rate. Now currently it is 8.5 in Sri Lanka. And the open market operation is the other tool that central bank uses to control money supply on daily basis. Where we use these stand-in facilities or repo or reverse repo auctions. It may be daily auction or the stand-in facility. I'll first explain what is this stand-in facility. Can anyone explain what is this stand-in facility?
If a bank has excess liquidity, they can park it overnight with the central bank. Similarly, if they're deficit, they can borrow overnight from central bank.
Yes, correct. That's the stand-in facility. So for each and every bank, there's a possibility if the bank has having excess funds and they may not, the bank does not want to lend it to other bank, or even after lending to other banks, there will be excess funds. If you keep it without any investment, you don't earn any interest. But through this stand-in facility window, what you can do, as a bank, you can park your money overnight basis just for one day with the central bank. That is we call stand-in deposit facility. The commercial bank can place a deposit, overnight deposit, with the central bank. The other side is also opposite, also possible. That means if a bank has a deficit and the bank is not in a position to borrow from other banks, or even after borrowing, still there's a deficit, bank can borrow from the central bank. Bank can borrow from the central bank. That is called stand-in lending facility. Deposit and lending from the central bank point of view. Central bank take a deposit or central bank lends. There's one more thing to recognize. When a commercial bank keeps a deposit with the central bank, there's no collateral, or the security is given by the central bank to the commercial bank. But whenever commercial bank borrows from the central bank, the commercial bank has to keep a collateral with the central bank. So remember that. Then what are the rates?
So what kind of a collateral that is?
Basically government securities,
Okay, sir, thank you.
treasury bill or the treasury bonds. What are the current rates?
Lending rate for half and borrowing rate 5 half.
Lending rate for half.
And borrowing rate 5 half.
So
5.5.
what do you mean? From a bank point of view, bank can borrow at 5.5.
Yes. 5 and lending.
Bank can lend
asset
to the central bank at
4.5.
So we call that the policy corridor. Okay.
Mr. Nishanta,
Yes.
you were just mentioning about a bank rate of 8%.
8.5.
About 8.5. What was that rate? It's an average rate, or like, how does that comes into it?
Yes, earlier before this COVID, it was 15%. It was 15%, but after during this COVID, the bank decided to reduce it, but with the link to the bank lending rate 5.5 with a margin of 300 basis points. So 5.5 plus 300 basis point, it becomes 8.5.
It's a penalty rate, right?
The penalty rate, yes, because you come to this window when you are in a very distressed situation.
Thank you.
Okay.
So what is this 20% liquidity ratio on commercial banks? Does it have any relevance with this thing?
There's no direct relationship with this. That is, that liquidity ratio is to safeguard the depositors and make sure that the banks are liquid. Anytime bank can meet their obligations. So from that risk management perspective, that liquid asset ratio requirement is imposed in line with the Basel III requirement. You will discuss that how to calculate that in the regulatory part, or maybe in the asset liability management part as well, because you have to maintain that as a regulatory requirement. So you have to comply that.
So is it maintained within the bank or
Yes,
in any instrument in central bank?
Sorry?
Is it maintained within the bank or is it under central bank instrument?
No. That has to, each and every bank has to maintain that. What central bank does, monitor whether you maintain it or not. It is to make sure the bank is liquid enough to meet its obligation, even in a distress or the stress scenario.
That means maintaining. So Nipuna here, that means the bank need to maintain provisions for liquidity, right? Like a pool.
Yes. So some of the assets that you have invested should be easily liquidated.
Within the bank, not in the central bank, within the bank?
Within the bank, yes.
All right.
So what do you mean by with in the central bank?
No, I thought of depositing it to central bank like SR.
No. That based on whatever your assets. There's a list of assets that that are considered as liquid assets, like government bonds, treasury bills, and things like that. Out of so in aggregate, that has as a total of, if I remember, total assets, that has to be 20%.
Right. Okay, thank you.
So when we calculate rates, sometimes the bank add bond rate on that 20%. That is why I asked whether it's under within the bank or it's in central bank.
What do you mean by bond rate?
Now, when certain occasions when we calculate a rate, a special rate for a customer, for 20%, we calculate bond rate as a interest gain for the bank. That is why I asked that question.
No, I think so. There's thing called risk-weighted assets. I think whenever you give a loan to the customer, there is a risk weight assigned to that. So based on that, you have to allocate a capital. So you forgone some interest on that capital. You may price it into the customer. That may be the scenario that you are explaining. I'm not sure what you are referring, but I feel it's like calculating the capital adequacy ratio. And definitely, whenever you grant a loan to a customer, it won't consider as a liquid asset. Is it clear?
Yes, sir.
Yeah, okay. So, may I go back to this open market operations?
So one more question: Is there any relationship between this bank rate and the interbank rates?
Not the bank rate and the interbank rate, but the stand-in deposit rate and the stand-in lending rate. There's a link to that. I'll come to that. Yes, the bank market rates. Yes. So as I mentioned, whenever the liquidity position is at a deficit level in the market or the surplus level, central bank conducts open market operations either to inject liquidity into the system or absorb liquidity from the system. Central bank will inject liquidity into the system when the system is at a deficit. As a system, in aggregate level, the banking system is at a deficit level. They need funds. So in that case, central bank will inject liquidity into the system. On the other hand, when the system is liquid or having excess funds, then the central bank will conduct a operation to absorb that liquidity into the system. So that injection or the absorption can be a temporary one or a permanent one. So methods available for the central bank, or the tools available for the central bank to absorb liquidity or inject liquidity from the system or to the system temporary is the repo transactions and reverse repo transactions. So daily OMO auctions means either they conduct a repo transaction or a reverse repo transaction. Central bank announces whether they are going to have any auction. If it is there, then they will announce whether it's a repo auction or a reverse repo auction and the amount that they are going to borrow or lend. But stand-in facility, it is available for any bank. There's a cutoff. Before that, you have at the end of the day, you have to come to that window and park your funds. Whether the central bank conducts auction or not, irrespective of that, bank can participate in the stand-in facility. The FX swap is another way that central bank uses to absorb or inject funds into the system. In the repo or reverse repo, what would happen? Either central bank gives out government bonds or bills and take in funds, or central bank takes in government bonds from the commercial banks and giving out cash to the bank. It's like a secured borrowing. I'll explain that once we discuss this product in detail. First, we have to have an understanding about what is a repo transaction and what is a reverse repo transaction. Remind me, at that time, I'll explain how the central bank uses this product to absorb or inject funds into the or out from the system. So here in the repo and reverse repo transaction, government bond or a treasury bill is used as a collateral. But in a FX swap transaction, foreign currency is used as a collateral. You lend or borrow money, rupee, against foreign currency. That is FX swap. We'll discuss this FX swap when we discuss in foreign exchange. Then we can, I'll explain at that point how we can use this to inject or absorb funds from the system. The other way is the permanent basis. Central bank can inject money or absorb money into the system or out of the system permanent basis. That is done through outright purchase or sales. This is outright purchase of government securities or outright sales of government securities. Again, remember, this is not the bond issuance. This is sort of a secondary market transaction, not the primary market transaction. The public debt department issues government bonds or treasury.
So I have a small confusion.
Yes. Hello. Hello.
One concern, Nipuna here. So what are the instruments to purchase or sales outright?
Government bonds and bills.
It's not like ordinary one, it's a secondary one.
No, that's what do you mean by ordinary one?
Ordinary one means the commercial banks purchases bonds and sell it to the secondary market. No, I mean that the central bank issues bonds to the primary dealers, means commercial banks to absorb excess funds, like something like that.
No. So in the bond process, first thing is issuing a bond.
Right.
The public debt department issues bonds through primary dealers, which includes commercial banks. They have their primary dealer arms. So through that, public debt department issues government bonds. Then primary dealers pay cash to the public debt department and take bonds. That is, from the primary dealer's perspective, you make an investment in government bonds.
Right.
Okay. Then public debt department acts on behalf of the government.
Right.
So those funds will be available in the system still, because it's in the government account.
Right.
Government maintains accounts with some commercial banks, basically government banks. So it's a fund transfer from within the system.
Right.
From one entity to another entity. It is the it is the process of borrowing of funds by the government.
Right.
But the outright purchase and sales is conducted by the domestic operations department of the central bank. This is done on behalf of the central bank.
All right, two different units doing operations in the market. One on behalf of the government, one is on behalf of the central bank.
Central bank, yes. One, the public debt department does it on behalf of the government to fulfill government funding requirement.
Right.
So that basically it's like government is borrowing funds from the market.
Right.
That's the primary auction.
Right.
Whenever there's a primary auction, even the central bank can buy government bonds from that issuer.
Right. Understood, sir.
So then those purchased bonds will be in the possession of central bank.
Right.
Whenever central bank thinks market liquidity is excess, central bank wants to absorb it on a permanent basis. Though it says permanent basis, I would say it's on a long-term basis. What the central bank can do, they can sell whatever their holdings of government bonds purchased through the auction or whatever method.
Mm-hmm.
They sell it into the banking system. Then the banks can purchase it from the domestic operations department. Again, they will call for an auction, outright purchase or outright sale auction. Then the central bank sells government bonds to the market and take money in. That money goes into the central bank, not to the government. So,
right.
So the money will flow out from the system. But on the other hand, if the central bank thinks now the market is in a illiquid position and it will be there for a long time, we need to give a long-term solution, then central bank do a purchase transaction, outright purchase. The DOD, Domestic Operations Department, will announce an auction to purchase government bonds from the secondary market. Then banks can submit their quotes to sell government bonds out of their holdings. Then the commercial banks will sell government bonds to the central bank. Central bank will give funds to the commercial bank. That will increase liquidity in the market on a permanent basis.
Right. Understood, sir.
Is it clear? So you have to make sure or differentiate between primary auction and this open market operations.
Yeah, now it's clear, sir. The confusion was because both functions are doing under central bank, two different departments. That's why.
Yes.
One from government debt department, and the other one is domestic operation department. That's why got confusion.
Yes.
Thank you very much, sir.
Okay. So don't worry, you will get more understanding about this whenever once we discuss auction process and individual products.
Right, sir. Okay.
So remind me at that point to discuss this again.
All right, sir.
So as I mentioned earlier, standing rate, there are two standing rates: standing deposit rate and standing lending rate. Deposit rate is low because central bank borrow at a lower rate and central bank lends at a higher rate, as you do in the market. You borrow at a lower rate, you lend it at a higher rate. Same is true with the central bank. So the standing rate are deposit rate and lending rate. Together we call a policy rate corridor or standing rate corridor. So this is the bottom, that is the deposit rate. This shows the lending rate. Okay, I'll switch to the board now. Did you see my presentation? Oh,
No.
so you should have told me.
No, sir.
Now you can see the board.
Oh, sir.
Yes.
Yes, okay. So these are the two rates as of now. Deposit rate, that means a commercial bank can place a deposit with the central bank at 1.5, correct? And a commercial bank can borrow from the central bank at 5.5. Now assume you have excess fund, you have 1 billion rupees. What is the minimum rate that you need to lend this fund? You have excess.
$4.5.
Minimum rate that you need is 4.5. Why? What's the reason?
That is the ceiling level of the deposit.
You can place this fund with the central bank and get 4.5.
Yeah.
So you want to do at a lower rate. Okay, now assume there's another bank which is a deficit unit. At what rate, or what would be the maximum rate that that bank is willing to pay to borrow funds?
That is 5.5.
It is 5.5. No bank would pay to borrow funds more than 5.5%. These are percentages. So nobody would lend below 4.5%. Nobody would borrow about 5.5%. That's the answer to that question. What is the relationship between this corridor and the interbank rate? So therefore, interbank rate that should be within this corridor. Is it clear now? No bank would lend below 4.5 and no bank would borrow above 5.5. So there has to be a borrower and a lender. So they should come to an agreement to do the transaction within these two limits. That's why interbank market or the interbank rate always falls within these two rates. Did I answer that question? Someone asked.
Yes, sir, thanks. You did.
Mr. Gishant, in this graph, I saw at the beginning of this graph, there is a incident that cost money rate is much higher than the central bank corridor.
Yes. If you go to that presentation, let me. Now you can see the presentation.
I think April 16th. 2016
Yes.
April.
Can you all see the presentation?
No, sir.
No.
Can see the presentation.
Now you can see the presentation.
Yes, sir.
Yeah.
Okay. So yes, there can be instances like this. This may go out of the range or the corridor due to special reasons. Here what has happened, the interest rate has gone up over the lending rate because market is so deficit in a desperate situation to borrow funds. So they want market interest to go up. So but still central bank has maintained the policy rate at that level, assuming that it is not required, but you can see after some time the central bank has increased the policy rates. Even somewhere here you can see it like almost at the bottom. Yes.
Isn't it a violation of interest rate corridor? Is it legal? Because the market is going up. Normally, the norm is banks to be maintain the rate within the interest rate corridor, right?
We can't say it's illegal, but in the normal behavior, it should be within the corridor like this. But in extreme situations, it can hit the ceiling or the floor. But in Sri Lankan context, you can see from January 2016 to April 2020, most of the time it has hit the ceiling. We can't say it's illegal, because if the demand is there, if somebody is willing to borrow at a higher rate than the central bank rate, that can happen, because they might have some. So if a bank wants to come to the central bank, they need some securities. They need government securities which can be keep as a collateral. If they don't have that, what would happen? They cannot come to this window. Then they have to borrow from the market at whatever the rate. Yes, there was a question. Hello.
So I have a question.
Yes.
Why do you call this as average weighted call money rate?
Because
I'm not from a treasury side, that's why I don't understand.
No, don't worry. So why do you call it average weighted? That means call money rate is like, this is a transaction between two banks. Say there may be within a particular date, there may be so many transactions, more than one transactions among different banks. So how at different rates, that can happen. So bank A may borrow from bank B at 5%, 1 billion. Meantime, bank A may borrow at 5.2% from bank C, maybe another 2 billion. Likewise, so there may be trades at different rates and different amounts. Then how do we represent the market? So what do? We calculate the weighted average of the rates. What do? We weight the rate by the amount. So we will multiply amount by the rate, then sum them up and divide by the total amount. Then it is called the average weighted call money rate. Is it clear? You know the weighted average concept?
Yes, sir. It's clear now. Thank you.
Any other question? Yes. Any question? No questions? Then shall I move into the new topic? You can find this on the classroom. You got it in advance.
Of course.
It is there. Have you all found this?
Yes, sir.
Yes.
Just say it is
Okay.
available.
If not, let me know. I'll do a demonstration how to get it from the. I'll show you from where to get these things.
We got it from by last week, sir.
Yes, if I remember, I think we uploaded this last. Okay, shall I move on? Do you have any questions? Okay, financial markets. So you can see the outline. There are few topics to discuss, and the objectives of this module or this topic, you may find it in the same thing in the syllabus as well. So at the end, be sure that you can do this. You should be able to explain the role of the financial market, different types of financial characteristics of different segments, distinguish differences, capital market versus money market, primary versus secondary, likewise. So everything is there. At the end, you test yourself and see whether you can do these things. I will try to finish this today itself, but if you have any questions anytime, as usual, you can ask. Okay, what is a market?
Where
Seller meet.
Sorry?
a place where buyers and sellers meet up.
Yes, where
Place
buyers
where
and
buyers and sellers meet.
sellers will meet. So, few example, this is a market. This may be the sort of picture that get into your mind when I say, oh, when the market word is here. So, what do you do here? You buy goods or you sell goods, correct? So there are many buyers and many sellers here in different goods. This is also another sort of market, but different compared to this. Maybe a somewhat sophisticated market. What is this? This is also a market. Can you recognize?
Yes.
What is that?
The rushness.
Sorry?
The rushness is less in the second picture.
Yes, sir. No. I mean, this logo, third one. That is also a market. You won't imagine this.
It looks like a
Online.
Yes, that is Alibaba.
Okay.
So that's also a market, isn't it? But you can buy or sell goods. That's a market. What is this?
Google Play.
Google Play. What do you do there? That is also a market, isn't it? These two, first two, you do with some physical goods. Even this one, some physical goods, but this one, it's not on physical goods, isn't it?
Yeah.
So,
virtual.
So physical markets, trade in physical goods, virtual market, selling physical goods, virtual market, selling virtual things. And there are other markets where you trade not only goods, services as well. So when we say market, it's all those sort of things. This is the general, this is about a market in general. But here what our focus is, so I need not to explain this. I think I explained all those things with the previous examples. Generally, market is a place or maybe an institution or maybe a mechanism where you bring buyers and sellers bring together to sell or buy goods or services. So it's not necessary to have a physical location. And like in all those things, not only a single good, not only a single service that you can trade. It can be a place or mechanism that where you trade many services and many goods. So, and need not to have a physical location. That is about, in general, about a market. So, but our concern is about a financial market. What is a financial market? As I mentioned earlier, it's a mechanism in like any other markets, but specialty is where we trade financial instruments and products. In the financial markets, we trade financial instruments or financial products. What are the financial instruments or financial products? It can be stocks, bonds, or things like that. There are some financial markets where which we trade commodities as well. You can say it's a commodity market, yes, but both commodity market and financial markets have so strongly binded together. There are interlinkages, so we cannot segregate commodity market and the financial markets. So therefore, sometimes we consider commodity as a instrument or a product traded in the financial markets. Not on commodity. When we say commodity, maybe precious metals or agricultural goods or things like that. Not only that, in financial markets, we can trade even weather, things like that. So that's why it says and other fungible items. And where we expect to do this at a lower transaction cost and which reflects efficient market hypothesis. We'll discuss this in few minutes. So basically, financial market is a market where we trade financial instruments and financial products. So all these two concepts again true for the financial market. We don't need a physical location to have a financial market. So it can deal variety of, I don't know, it's not possible to say goods, but services, because different type of financial products are traded in the financial market. So there are two types. We have, as we discussed, savers or the excess units and borrowers, maybe companies or governments. They are the big borrowers in any economy. Savers, individual savers, are the lending party. There are institutions called banks. So what do? Savers, we place deposits with the banks. Then banks grant loans and other overdraft facilities to maybe for company or maybe to the government. This one is we called indirect finance because lenders and borrowers meet or go through the intermediary bank. Two different contracts. lender has a contract with the bank in the form of placing deposit. The bank has another form of contract with the borrower, or the borrower has a different contract with the bank in the form of loans or overdraft. So this segment we call as indirect finance. And the other part to the financial markets, that's the major composition of the financial markets goes through this, where we have two major markets called share markets and bond markets. The companies or the companies, not the governments, companies issue shares. So the investors, they buy shares directly from the company. So this is direct financing. The same can be done through bonds. But what is the difference between share and bond? In a share, the investor gets a ownership of the company, share of the ownership. But in the bond, this is a lending to the company or the government. So lender has a claim against the borrower. You don't own the company, but you have the claim against the borrower. So it can be company issues bonds and the investors buy bonds, or government issue bonds through the bond market and investor buy bonds. So this part is the direct financing section. So even though I have put it as money market and capital markets, this is not the exact segregation of money markets and capital markets. Thing is, most of the things goes through this indirect that we can classify. Most of them are money market. We'll discuss what is money market and capital markets later. So what is the, yes, any question?
Yeah. Where the commercial papers fall in this graph?
Commercial papers, bonds, even treasury bills, this direct finance. Is it clear?
Yes, sir.
Okay. So what is the role? There are lenders like households, individuals, business firms. There may be governments, those who can lend, and foreign parties, foreigners. And on the other side, deficit units, again, that can be business firms, government, households, or foreigners. The same parties in the both sides, but at different capacities and different roles. So in Sri Lanka, government is the biggest borrower. Then comes the corporates. But in some other countries, corporates or the business firms may be the biggest borrowers. However, as I explained earlier, in the indirect financing, funds from the lenders or savers flow into the financial intermediaries, maybe banks or other financial institutions. And from that financial intermediaries, funds will flow to the deficit units, borrowers. Or these financial intermediaries may go through the other financial markets and do invest in the issues. What is the difference? These two paths. Here, financial intermediary may be a bank giving a loan to a firm. Giving a loan to a firm. That goes through this route. But a bank may purchase, as one of you asked, a commercial paper or a debenture issued by a business. That goes through this path. That's a direct finance. But then the lender would be this financial institution. The same thing can happen for the savers, individuals. You can go through this direct financing method by bonds or shares issued by these parties. So that's what happened in the financial markets in general. I think you have this knowledge, have an overall idea what's happening. So what's a financial transaction? It's a contract between maybe two parties, maybe two institutional units, or maybe a institution or a individual, where you create an financial asset and exchange it or trade it. When you trade, or it may be the end of the financial instrument, or you may transform one form of asset to another form of assets. We'll discuss later with the coming modules or topics, how do we transform things. So however, financial transaction is an agreement between or a contract between two parties. Sometimes you don't exchange. So if you go to a market to buy something, you pay cash, you get some good, or you pay cash, you get some service. Even here, you may not get a good. Either you may get cash, and at the end only you have to transfer cash to the other party. Not both parties exchange something in each and every transaction. Depending on the transaction, the nature may be different. It may be just an agreement between two parties without exchanging anything at the inception. Maybe later you may exchange funds. So what are the functions? So financial market provides information about the financial assets traded on the markets. So price is a basic information about the product. So what is the price of a particular product? Maybe a bond, maybe a share, maybe a commodity, maybe an option or any other derivative product, whatever. Not only that, other information about the issuer or the borrower. So that should be available in the market. Provisioning of those information is one of the service, and offer liquidity. What does it mean, offer liquidity? Here the liquidity means the ability to trade the financial instrument without incurring a huge cost or having an adverse impact on the market price. Say, price of the product now 90 rupees, you want to buy 1 billion worth of that product. Whenever you go to the market and say, I want to buy 1 billion of this, if the price going up, jumps up from 90 to 100 or 110, it is not that liquid market. You should be able to buy or sell any quantity that you want at the current market price, or maybe very close to that, without having big impact on the price. That sort of markets we call or the very liquid markets. Others are illiquid market. When the market is illiquid, you will incur cost of buying or selling, or that we call transaction cost, or get an adverse impact on you. So the financial markets should be able to reduce the transaction cost, that is mentioned here, reduce the cost of buying and selling. Not only that, share in risk. So in the financial markets, we share the risk among ourselves. If you go back to this, if an investor buy bonds, what would happen? Say one business want to generate 1 billion rupees. There are two ways. A single bank can lend 1 billion rupees to that firm. What would happen? The full risk of this firm is taken by the bank. But instead, if the business can issue a bond, what would happen? That bond will be purchased by maybe 1,000 or million of investors. Then the risk of this firm will be shared among all these investors. Even the business goes bankrupt, impact on individual would be very minimal because they have invested only a small portion. But whereas if it is the case, the bank has fully funded that investment, then the whole impact would be on that single bank. That is risk sharing. Financial markets help us to share the risk among many participants. Then the other one is the financial market facilitate to allocate financial resources, that means funds available efficiently among the required units or into the correct position. So this is just an example. Whether you invest in equities or debt, or start in a manufacturing firm or another service provider, things like that, depends on how efficiently you can deploy your funds. If the efficiency is less, the lender will charge more. If that efficiency is good, you will charge less. So that's why different segments in the economy borrow at different rates, considering the risk, return, and all those things. So the financial markets help us to allocate the available funds into different segments in more efficient ways. So we are about to move into the characteristics. What are the characteristics of a good or the well-behaved financial market? I think before we move into that, better if we can take a break here. Now it's 10:30. We'll take a break here and move forward. Before we take a break, if you have any questions, you can ask. Or hello, do you have any questions?
So far, no.
So far, so good. And I would like to know, indeed, these things or need to discuss more, or I think you have some background, so we can move quickly, isn't it? Or the speed that I'm moving forward is too slow, too fast, or any comment?
Cryptocurrency also financial market, right?
I didn't hear that.
Cryptocurrency also financial market, right?
Yes. Now it's also included in the. Yes. Yeah. Indeed, cryptocurrency. It's not the financial market. I think it's an instrument in the financial market. It's like money.
But Sri Lankan doesn't have access for that currency, right?
No, not yet. Officially not. Any other question? If you don't have any questions, we'll take a break.
Sir, this
Yes.
commercial papers has a same security as bonds and bills.
What do you mean by same security?
Since the commercial banks sell it to the customers, is there same security for the deposit?
You mean the risk?
Yes.
Whether it's safe as government securities
Yes.
or not?
Yes.
No. So bank is a completely different institution compared to the government. So in that the risk is in commercial papers. If it is issued by a bank or any other institution, corporate, the risk is high compared to government. We will discuss this again in the future. The commercial paper is the equivalent thing to the treasury bill. Treasury bill is issued by the government to borrow funds for a shorter period. The same thing is done by the corporate. We call it a commercial paper. So you take two different credit risk. Can you trust a bank as much as the government, or more than that? Which one you mostly trust and why? What's the difference? Government can print money at any time. That's the basic assumption that we have, and that's why we think in any country locally, government is the zero risk entity. Correct.
Thank you, sir.
Anything else?
But if government printed notes, the inflation also goes.
Yes. There are consequences, but the government won't default.
Yeah.
Whether that printing money is good or bad, that is a separate argument. Even though you get that money back, whether it carries the same value. I just wanted to show you. So whenever you logged in, you can see this screen in the Google Classroom. You can see these tabs: stream, classwork, people, grades. Is it? So in this stream, when you click it, all the announcements will be there. In the classwork, you can see the materials, what we have posted. In the people, you can see who are the members of this group. These one, I think they haven't accepted the invitation yet. Better please accept that, then you will be able to access. So grades, don't worry about no grades so far, and whenever there's an online test or something like that, grades will appear here. For the time being, what you have to consider, pay attention to this stream and classwork. All the announcements will be here. Is it clear? So this is the place where you can get the apps. So this is the classroom app. You click it, you will go to the same window. Now I am trying to show you our survey. You can see the results. Hello.
Yeah, can see.
You can
Yes.
see.
Yes.
Only
We can see that.
only 48 has responded. Now there are 56 active in the class now, but only 48 has responded. Better you others please respond. You can see 68% of this 48 work for banks and 8.3% work for other financial institutions. There are 8.3% from corporate, primary dealers, insurance companies, fund management, likewise. And there are around 10% from Treasury front office, other small percentage from middle office, back office, yes, again around close to 10%, risk management, not from operations and trade, sorry, other. There are few from brokering firms and fund management firms as well. Experience, that's interesting. Most of you have more than 10 years experience in the, hopefully in the banking sector, and others more than 5 years. So about 78% having more than 5 years experience. So the concepts that I have discussed so far should be very familiar to you. Educational qualifications, you are having masters 37% and another 18% having bachelors, so 50%, more than 50% there. So whatever the qualification, don't worry. And even though with the bachelor's, masters, whatever the background, don't worry. So if you cannot understand, please ask questions, then we'll clarify that. Whether you have a financial background or not, it won't matter. What matters is your commitment. So some of you have done CABF, DABF 35%, so you have knowledge on banking. There are 18% none. Maybe they may be students, then this question may be from them. They are following DABF or the CABF. Few undergraduates also there. Good. So this is the results so far. Even I think now you have some idea about the participants in this group. So this gives me a good picture about you, and now I can give priorities to some sectors than the others, because I mean in the topic wise, depending on your background. I know now I have some fair knowledge on what is your background and what are the things I think that you know and where we should pay more attention. If even others can feel it, that would be better. So we'll leave it and move into the class. We'll go back to the presentation. Before we go to the presentation, do you have any question?
Sir, is there any way where we could get a few past papers for understanding purposes?
Generally what we do, we will distribute, we can post one past paper. Now the thing is, do you need it now, immediately, or
No,
towards
sir.
the end? Because we
Sorry?
haven't conducted the exam for the 2020 batch, so still we don't have the
Okay.
paper available.
Just for understanding only, sir, at your convenience.
Yeah, if you can wait few more months, we can give the latest one. I think that would be better.
Okay, sir.
And we'll check whether you can get it from the sales counter. Yeah, I'm not sure.
That is not possible, right?
That is
With
not
Menaka
possible.
also.
That's not possible.
Yeah, that is not.
Okay, we'll share one paper.
Okay, sir. Thank you.
Yes, better to have the 2021, no? The latest one. Otherwise, we can share 2019 one. No, better. We'll wait few months, and once the exam is over, we'll share this latest one.
Okay, sir.
Any other questions?
One question, sir. Last week you said that we are having the exam on October. So, like, which month we can cover the syllabus? Like August or like September? Any idea, sir?
Hopefully, by end of August and September, we can keep for the revision classes, and probably that would be the way. That depends on how fast we can move. Even though we schedule, depending on how many questions that you ask, what's the time that I have to spend answering your questions to make it clear.
Okay.
But we'll try to stick into the schedule. Okay. Any other question? If not, so we'll discuss about what are the characteristics of a good financial market or a well-run financial market, as I explained earlier. So the financial market should facilitate to reduce the transaction cost. It should be at a minimum level. What do you mean by transaction cost? That's a concept that you have to understand. What does it mean by transaction cost? Is it the price that you pay to buy a financial asset? What does it mean by financial cost? Sorry, transaction cost. Anybody? Any idea?
To perform a particular transaction, there is a transaction cost involved. It's like for the equity market, there is a brokerage like this.
Yes. In the finance, yes. It's not.
Hello,
it's
sir.
not.
The cost incurred to execute the transaction.
Yes, that's the cost that we incur to enter into the transaction and settle the transaction. So it's not the price that you pay to buy that instrument or to make the investment, but to do other works. As one of you explained, if we purchase a stock, we have to pay a brokerage. That is on top of the price that we pay to buy the stock. Or before you lend to a customer mortgage, what are the things that you do? You have to evaluate the customer. You may visit the customer's premises or the facility, do an evaluation. There are costs involved in that. So you may have to incur legal fees because you may have to do a, say if it is a land, do a title search, get other extracts and do or follow the legal procedures. Then you pay the stamp duties or other taxes. All those things becomes part of the transaction cost. It's not the price that you pay. Not only that, see, whatever the instrument that you are going to trade is not that liquid, or there are not that much of buyers and sellers. You may have to spend time and spend money to find an opposition party. So for an example, if you want to buy a land, you have to spend some time, some money. You have to travel here and there to see the land and meet the seller, things like that. All those comes or account as the transaction cost. In the financial market also, if the markets were not there, you want to do some investment, you need to do a survey or research or do some sort of activities to find the other party. If you want to make an investment, then you need to find a borrower. Then you will have to evaluate the borrower. So that will incur cost. As an individual, we cannot evaluate the borrowers. It's very costly. But through the markets and the intermediaries, they does it on behalf of us. So we trust them and we enter into the transaction with that intermediary. Or there are rating agencies, things like that. They do the evaluation on behalf of us about the borrower. So likewise, all those things has reduce our transaction cost. But different markets, there are different transaction costs depending on the nature. However, in a good financial market, the transaction cost should be at a minimal level, at a low level. When the other transaction costs are low, people will tend to do transaction in that market most. Then the second one is about information. The market holds all information. So, not talk about what are the information available in the market. What are the historical prices? What are the historical volatilities of prices? Movements. What's the pattern of price movements in historically? What are the events happen historically? And what was the reaction for that particular event? All those things are market information. Not only that. So there may be some other information available in the public domain. So maybe a firm has announced a merger. They are going to merge with some other party, or going to do a takeover, or maybe invest in a new business. They are going to diversify their business, things like that. They have taken the decision and has announced to the market. Then that information should be available for each and every participant in the market at a accurate level. Not only that, if possible, even the private information, that means which are not public, if it is available to everybody, then that could become public. However, that also matters. So information gathering should be accurate and widely available. If the information set is available only for a particular set of participants, they take the advantage. They can drive the market. Not only that, So when there are investors and borrowers, investor should know about all information about the borrower. Otherwise, there will be moral hazard issues and things like that, or the adverse selection problem. Those can be there if the information is not available properly. And the market should have confidence to lend. Whatever the promise given by the borrowers, the lender should be able to have a trust on that promise and act on that. So then only lender will lend cash to the borrower. Otherwise, nobody will lend to any other party. So that trust building, that has to be done in a proper or the well-run financial market. So to build that trust from the regulatory perspective, they should build investor protection and confidence. So that's why government intervenes in the financial markets and set up few regulatory institutions to regulate different segments of markets, that is to build up the investor protection. So that's why we have central banks, Securities Exchange Commission, insurance boards, and things like that. They regulate each segments in the financial market. So to have a good financial markets, we need all those things. So then financial market, we can segregate into different categories depending on different characteristics. So here we are going to discuss few key segregation. So most of them, I think you know these. First thing is based on the maturity. How do we segregate the financial markets based on the maturity of the products? Money market or the capital market. What's the difference between money market and the capital market? Money market, where we trade instruments with less than 1 year maturities. Where we trade in instruments with less than 1 year maturity. That is called money market. On the other hand, capital market is the long-term funding or borrowing activities. That means maturities of these transactions are more than 1. That's the segregation between money market and capital market. So there may be different products traded in money market and capital market. There may be some products that may trade in money market and the capital market both. That can happen. That it is possible. But depending on the maturity, we classify whether it's money market or the capital market. Whatever instrument with the maturity less than 1 year, we trade it in the money market. Others we trade in the capital market. We'll discuss when do we use money market and capital market in the future. The next classification is based on the nature of the asset traded. So basically, debt market and equity market, as I showed you earlier, we can segregate this market into financial markets into 2 groups, debt markets and equity markets. What's the difference? Again, equity market gives you where you can buy the ownership of a particular firm. If you buy a share, what does it mean? You get the share of the ownership of that particular firm. That is where equities are traded. Investors get the ability to obtain the ownership of a firm. But in the debt market, you don't get any ownership, but you can lend to the firm. Then you have a financial claim against the firm. In any event, liquidation event or a bankruptcy event, debt holders get the priority than the shareholders. What does it mean? In any liquidation event, whatever the proceeds comes through the liquidation process, first that will flow to the bondholders, not to the shareholders. Once you paid all bondholders and other lenders, then if there's anything remaining, then that part only flows into the shareholders. Shareholders are ready to take the risk and absorb the losses. Debt holders also sometimes they may have to absorb losses, but they have the priority there. Then the other market segment is based on the whether we create new assets or we trade existing assets. The market where we create new assets, we call it a primary market, and where we trade the existing asset, we call it as a secondary market. In the meanwhile, we'll discuss in detail about the primary market and secondary market. Then the other classification is based on the delivery method. Whether you settle the transaction immediately or not. That is where we settle the transaction immediately, that's we call cash market or the spot market, and the others we call derivative market. So some of you might know this cash and spot jargon in the foreign exchange market. But here, when we say cash and spot, it's not exactly the thing that we discuss in the foreign exchange market. Cash and spot, we can say immediate delivery. What is immediate is different in different markets. So we settle the transaction immediately. That is we call cash market. Derivative market is not that we settle the transaction immediately, but in a future date based on the market conditions prevail at that time, depending on another performance of another financial instrument. Then the other categorization is exchange traded and the over-the-counter market. Over-the-counter market is just an agreement between two parties. It can be two banks, or a bank and an individual, or a bank and a corporate, whatever. So all the terms and conditions are agreed by both parties. They discuss, negotiate, and enter into the agreement. What is the price? What is the maturity? What is the amount? When to settle? How to settle? All those things are discussed and agreed by those two parties. But in contrast to that exchange traded market, there's an entity called exchange. For an example, in Sri Lanka, the only exchange that we have, Colombo Stock Exchange. So in the exchange traded markets, it is regulated. Each and every product trading the exchange traded market is regulated, and they have defined the terms and most of the terms and conditions of the transaction. What is the amount? What is the maturity? Things like that. Only thing that two parties can come to an agreement is most probably be the price. What is the price that they trade? But all other terms and conditions will be given by the exchange. Then all the settlement will be taken place through the exchange. So therefore, the most important thing is in the over-the-counter market, each party takes the risk of the other party. But in the exchange traded market, it's not. even though you do a transaction with another party, ultimately you settle it through the exchange with the exchange. So therefore you take the risk of the exchange. Exchange has the obligation to settle your transaction. Then the wholesale or retail market. So whether we do a trade in large volumes or small volumes, when I say large volume and small volume, I don't have a benchmark amount to say this is large, this is small. Even in the same country, depending on the different products, the wholesale amount and the retail amount may vary. And remember, in this course, we mostly focus on the wholesale market. How do we do a transaction and settle the transaction? What are the things that we have to consider when we do trades in the wholesale market? That means in high volumes. So this is the explanation of money difference between money market, differences and similarities between money market and capital market. As I explained, money market maturity less than 1 year. Instruments are with maturities less than 1 year. Even in the money market, capital market, meet borrowers and lenders both. But we use money markets to fund our short-term requirement, basically our liquidity requirement, to fund our liquidity requirements, maybe working capital requirements, things like that. But in the capital market, we raise funds for a longer period to make capital investment, maybe to establish a new production facility or things like that. So that's the difference between money market and capital market. Then the debt and share, I think I explained this. So one more thing. The first thing, as I mentioned, in the debt may be issued by an instrument or a government or any other corporate, where you get the, where you have the claim against the issuer, whoever who borrow funds. The investor has a claim against that issuer. Issuer has promises to pay some amount, maybe on regular intervals, or maybe at the end of a particular period. So there's a contractual obligation the issuer has to meet. But in the share market, shares, there's no such thing. You buy a share, what does it mean? You get the ownership of the firm. So then you are responsible about the firm, whether it makes money or not. But in reality, what happens? Individuals, you cannot go and run the business. You appoint some agents to manage the firm on behalf of you. We call them board of directors. They'll manage the firm on behalf of you, but you have the ownership. You can vote to select directors or remove directors, or in other major decision-making events, you have the voting rights. With that voting rights, we call them, the shares we get, we call them common shares. And in the shares, in the debts, there's a specific maturity. After some time, the borrower has to pay that borrowed amount or agreed amount to the lender. But in the shares, there's no such maturity. You get the ownership of the firm, that's it. You don't get that money back. But only thing is, we can transfer your ownership from one person to another person, or one entity to another person, or person to an entity in the secondary market. If you don't want to hold the ownership of a particular company, you can sell your shares to someone else. So you go out from that, or or you give up your ownership. So these are few instruments that we can see in the debt market: treasury bills, treasury bonds. So what are treasury bills? What are treasury bonds? Treasury bill is the short-term instrument used by the government to borrow funds for short maturities, less than 1 year maturities. Treasury bonds are the instrument that the government use to borrow for long tenors, more than 1 year tenors. And the debentures is the equivalent of treasury bonds. That means long-term bonds issued by corporates, not by the government, but issued by corporates. Those we call debentures. Commercial papers is the equivalent to treasury bills. Short-term issuance by the corporates to fund their short-term funding required. So there may be variations in debentures or basically if we call in general bonds or the fixed income securities, there may be some differences and variations which we will cover under fixed income securities. In the shares, common shares, where you have the voting rights to vote in key events of the firm decision making process. And preferred shares maybe without any or preferred shares or preferential shares without any voting powers, but you may have some other options in the preferential shares, or maybe dividend, fixed dividend that company promises to pay, things like that. And again, I would like to highlight it here. So in this treasury module, we are not going to discuss about share markets and shares, but debt related each. And the primary market and the secondary market, as I mentioned earlier, that depends on whether we create new asset or we trade the existing asset. Okay. New assets. When we say new asset, say treasury bond. Treasury bond is the asset class. It's not the asset per se. It's the asset class. But time to time, the government may issue different bonds. Say, even last Wednesday, Tuesday, there was an auction, bond auction. So that issue a new bond series. That's a new asset. Maybe a month ago, government might have issued a separate bond series. That's a separate asset. But altogether, we call them government bonds. Government bonds, but different series represent different assets. So the creation of new assets is happening in the primary market. That can be done through auctions or IPO. What does it mean by stand for IPO? That is the initial public offering. This is the word that we mostly use in the share market. If a company is going to issue shares for the first time in its history, it's an initial public offering. The firm is established maybe 10-20 years back, but managed as a private company by few individuals, put in their own funds, and they manage the firm by themselves. Now they want to sell some of their shares, ownership of that firm to the general public. A firm doing that for the very first time, it is an initial public offering. Or that can be a negotiated sales or private placements. Negotiated sales means you discuss only with few selected parties and negotiate with them directly with individual parties and sell your asset, whatever the new asset, maybe a share, maybe a bond, to those parties. But even in the negotiated sales, whatever the instrument that you borrower sold to the investor, that can be traded in the secondary market later. But in the private placements, generally it's not the case. You negotiate with few selected parties and borrow from those parties. And it is not publicly available for others to make investments, or the parties, those who have already invested in those, they cannot transfer their ownership to another party or trade it in the secondary market. So primary market, where we create new financial assets. So treasury bill auctions, treasury bond auctions, initial public offerings, those are the primary market activities. Whereas in the secondary market, whatever the bonds or shares already issued through a primary auction or IPO, you trade in the secondary market. And the other key is, in the primary market, transaction is taking place between the investor and the borrower or the firm. Whatever the funds generated or invested by the investors will flow into the borrower or the firm. But in the secondary market, the original issuer, nothing to do with the original issuer. No cash flow, no funds will be flow to the original issuer or the borrower. The secondary market transactions have taken place between participants in the market, or in other words, in between two investors. One investor is willing to give up or transfer the ownership, transfer claim to another party. The second party is willing to take it, buyer and the seller. So the cash flow and the fund flow would be in between these two investors. There won't be any fund flow to the government if it is a secondary market transaction in the government securities. There won't be any fund flow to the government. If it is a secondary market transaction in shares, there won't be any funds flow into the company, but just between two parties who enters into the transaction. So, but secondary market helps us to find out the prices, because you try to come to the best deal. Whenever you sell, you try to sell it at the best price that you can sell. Meantime, buyer, he will try to buy it at the best price for him. That means he tries to buy at the lowest price. Seller will try to sell it at the highest price possible. So there's a trade-off. So that ultimately the trade is expected to happen at the fair value. That will decide the market prices. That is the process of price discovery. What is the real value of an investment or a financial instrument? And meantime, it will provide liquidity. What does it mean? As I mentioned, the liquidity in the instruments, that means you can sell or buy the instrument without incurring huge cost in transaction cost or having adverse impacts on the price, because whenever there are a lot of buyers and sellers in the market is liquid. At any price, any volume, there are buyers, there are sellers. You can do that. So provide liquidity, not only provide liquidity to that instrument, not only that, even the investor who has made an investment for a long period, now for some reason he needs liquidity, that means funds, cash. He can immediately sell his asset and generate cash, convert some asset into a cash. So that will provide liquidity to that investor. So the secondary market facilitate that. And with all these things, price dissemination and all those things, market efficiency will improve, because a lot of people trade in the market. They try to find out what is the current price and discount all the information available, use all the information available and decide the price. That will improve the efficiency in the market. So secondary market helps us in that trade. So then, based on the delivery methods, how do we segregate the market? Cash or spot market and the derivative market. So as I mentioned, cash market is the immediate delivery. It can be the same date that you enter into the transaction and you settle the, or you do deliver funds and get your instrument. Or it may be tomorrow, after 1 day's time. Or it may be after 2 days time, or it may be after 3 days time. Depending on the market and the instrument, this immediate delivery may differ. For an example, if you enter into a transaction to buy a bond, government bond today, when do you get it? Do you get it now, today itself? Assuming today is a working day. If you enter into a transaction to buy a government bond, will you get it today?
No, after 1 year.
After
1 year.
After 1 year? No, I mean not the maturity proceeds. I mean, when do you get the ownership of that bond?
Same day.
Hello.
Same day.
You get it same day.
Hello, sir.
Yes.
Can you ask the question again, please?
Yes. Whenever you enter into a transaction, yes, as a bank, if you enter into a transaction to buy a bond, assuming today is a working day or a business day, if you enter into the agreement or the transaction today, when do you get that bond?
It is T+2, I think.
T+2. What does it mean by T+2?
It's after delivering the funds.
Yes, after delivering the funds. So when do you deliver your funds? Okay. Yes, definitely. You have to deliver your funds to get the bond. That ownership of the bond. Yes, true. But when do you deliver funds?
On the value date.
Value date. What is
Yeah.
that? What is that value date?
It's today.
Is it today? Or tomorrow? Or day after tomorrow?
If you
Day after tomorrow.
Day after tomorrow. In Sri Lankan context, that the settlement will happen after 2 days of the transaction date for the government bonds. That's why, say, even treasury bills, same. Generally, when do we have the primary auctions for treasury bills?
It's on Tuesdays.
Wednesdays.
Wednesday. Generally Wednesday. Generally Wednesday. then you settle it. That means you transfer funds to the government, and government gives you bonds on
Friday.
Friday, not Wednesday itself. Okay, I heard the answer immediately, or the now, or same day itself. It's not the case. So that is true for an individual customer who walks into the bank branch and say, I want to buy a treasury bond worth of maybe 1 million or 500,000, something like that, treasury bill or a bond. Yes, for that customer, you do that transfer immediately. T equals 0. Yes, but here we are talking about, as I mentioned, we are talking about the wholesale market and the interbank market.
So is there any reason why it can't happen immediately? Like, why
Yes,
can't
yes,
immediately?
yes. Some of them are historical because you have to follow some steps before you settle. Earlier, without these systems and things, it takes time to send the confirmation to the other party and make sure that you have entered into the correct transaction, then inform the central bank or whoever who do the settlement part, real settlement part. So therefore, there was a time delay. So still we keep that time frame to do the administrative parts and to get ready with the funds and bonds. That is the reason basically.
Okay, thanks.
So in the Sri Lankan context, government bonds are settled after 2 business days from the transaction date. So this is a very important concept that you have to understand. Transaction date and the settlement date or the value date. Let me switch to the board. I think one of you had tried to ask a question. Yes, please ask.
So once the bond or the bills issued, it exists as a electronic form, right?
Yes. Nowadays it's just a electronic recording in one of the databases. Yes, no physical certificate that or security that you get. Before we move into that, I think in 2000 or 2002, it was you get a hard copy or a piece of paper with coupons attached to it. Whenever you want to get the coupon, you have to carry that coupon to the central bank and present it and get the cash. But now it's not the case. It's electronic form. Just record the amount and the name of the investor. So this person is holding this much worth of security. So this face value security. It's just an electronic recording. So,
I think that is called scriptless transaction method.
Yes.
Yes. Then will it happen immediately, that settlement, or will it still it takes T plus
2? Yes. But
no real time settlement.
No real time. Yes.
So once the bill is purchased by a commercial bank, is it the same bill is distributed and sold to the customers from the commercial banks?
I didn't get that question.
Now, if it is a high value bill is purchased by a commercial bank, is it the same bill is distributed and sold to the customers with by keeping a margin?
Yes. You buy the lot and you distribute it to the customers.
So is it okay to sell it under same ISIN, because the ISIN is same? So if we separate into parts, how can we identify them?
What do you? So
the security ID.
Security ID is there. Yes.
the security ID is the same for a large amount of bill, but when it comes to separating and selling it to different parties, what happened to the security ID?
It remains the same. Security ID is for the whole chunk. It's not for a. It's like, say, you can see me, no?
Yeah.
So I have these 4 panes. I sell this all 4 together as a one bunch. The ID is assigned security ID, that ISIN is given to this whole bunch. But so there's an amount attached to each. The whole bunch may be 1 billion rupees. Then when I divide it into 4, it's 250 million each. What I can do, I can sell this 250 million to one party, the second one to another party, third one to another party, and fourth one to another party. So what would happen in the records, the amount 250 million party A, 250 million party B, 250 million party C, 250 million party C, party D. Likewise, it will be recorded under different names, and the name and the amount and the ISIN number.
Right. Okay, understood.
So that is what we call fungible. All 4, even now you can see different colors, but in a good example, all 4 of these are identical, no different. So that's why we call fungible. Financial instruments, those sort of financial instruments are fungible. So what in a bond, what it character they create from one bond to another is the issuer. Who is the issuer? Then what is the maturity date? And what is the coupon rate? So every bond we can identify through this. Very rarely there would be 2 different securities with the same issuer, same maturity date, and same coupon rate. If it is there, that's why to uniquely identify this ISIN is issued. This is a unique number given for a particular series. International Security Identification Number. So one issue is having one number, but you can segregate based on the amounts into or distribute among different customers. What would happen? IC amount and the name, or maybe NIC number will be recorded. So in this IC, whatever IC, this much of amount is held by this person with this national identity card number. Likewise, there will be a list of bondholder of a particular series. Whenever one investor sell it, you delete that row and write the name of the new investor. What say ISIN like this, amount 500, name is A. There's a record like this. What does it mean? A security issued with this IC, out of that 500 million worth of securities currently held by party A. Assume party A decides to sell half of it, 250 million worth of securities. So after that transaction settle, what would happen? This will delete and write there as 250. Then this is okay. There will be a new record like this. Then the two parties are holding the same bond for the same series, but with two different amounts. Need not to be the same amount. Maybe this is 350. This is 150. Depending on the so that's how it happens. So this is just a register. Public Debt Department of Central Bank of Sri Lanka, they maintain this register, but it's in the electronic form. Is it clear?
Yes, sir. Thank you.
Then I'll go back to the trade date and settlement date concept. So this is again, if you are not familiar with this, something that you have to remember throughout this course, and this is very important. So what is trade date and settlement date? We call it value date as trade date is the date where you come to the enter into the agreement. On the trade date, two parties enter into the agreement. One party will say, I am selling this much of bonds. The other party will say, okay, I am buying. Even the amount and price is agreed on this date, on the trade date. So that has to be a working day in the market, that then only we can do a negotiation and enter into the transaction. So we denote it as T equals 0. Then, but you enter into agreement today, but you don't transfer the ownership or the funds movement on the same day, generally. If you need, you can do that. Generally, it won't happen. There are market conventions, as we discuss now in Sri Lankan market. I'll just take that government bond example. In the government bond market in Sri Lanka, the settlement will take place after 2 days. That's why we write it as T plus 2 business days. From the date that we enter into the agreement, after 2 business days only the settlement will take place. What does it mean by the settlement? The buyer will transfer funds to the seller. The seller will transfer the ownership of that asset to the buyer. So that's why we call it delivery also, not only settlement, value, or maybe we can tell it as, or call it as delivery date as well. The ownership is transferred on the value date. Is it clear? It's not like that a customer walks into a bank and say, I want to place a deposit. So what you do, you take cash and issue the certificate immediately, real time. It's not the case in the wholesale market. Yes.
Excuse me, sir. Now T plus 2 means transaction days plus after 2 days. cash date is today. After 2 days, tomorrow and day after tomorrow, we are taking place as the spot date, like value date.
If this is Monday, assume no holidays. Tuesday is here. This is Wednesday.
Right. Transaction
that entered into Monday will be settled on Wednesday. If you enter into the transaction Tuesday, it will be settled on Thursday. If you enter into the transaction Wednesday, it will be settled on Friday. If you enter into the transaction on Thursday,
next Monday.
If you enter into the transaction Friday, it will be next Tuesday. Assuming no holidays in Tuesdays or Wednesdays. If it is a holiday, say assume you enter into the transaction Monday, Tuesday is a holiday, then what would happen? It's not Wednesday, the transaction will be settled on Thursday. Assuming Tuesday is a holiday.
Right.
If you enter into the transaction on Monday, transaction will be settled on Thursday. Still T plus 2.
So is this a norm or is there any restrictions regarding?
It's a norm. It's a norm.
So it can happen even after 2 days or even before 2 days.
Yes, that depends on this agreement. If both parties agree to settle it today itself, that can be done, depending on whether the systems and because to do the settlement there are procedures that you have to follow. There are cut-off time given by the scriptless or the CDS and the RTGS system. So if still you have the enough time to settle this transaction, you can do it even the day itself. We call it T equals 0 or the cash generally.
Is only for the primary market or is it?
No, even in the secondary market.
Okay.
Even in the secondary market, this is the way. Primary market, you can't change the settlement date because the central bank will announce the settlement date. They conduct the auction on Wednesday and settle it on Friday. You can't change it. But in the secondary market, two parties can agree. If they need it tomorrow, they can do that. But if you don't mention anything specifically, it is considered as T plus 2 in the government bond market in Sri Lanka. But if you go to the international market, government bonds in US treasuries or US government or UK government, they settle in T plus 1. You do the transaction Monday, the transaction will be settled tomorrow.
So what are the settlement systems used to do fund transfers and all?
In Sri Lanka?
Yeah, in Sri Lanka.
It's the RTGS, real-time cross settlement system. RTGS and the SSSS. Scriptless Securities Settlement System. These are the two systems used to settle the government bond securities in Sri Lanka.
So, but in equity market, you have a to settle it T plus 2, but you get the ownership at the same day, no?
In the equity market, I think now they have not that, but they have a certain period. No. Yes, you get the ownership same day, but only thing is, since you are going through a broker, the thing is you have to keep money 1 day in advance with the broker.
Yes.
That's why. Otherwise, the real settlement will take place on the, say, I think it's T plus 3, the transaction will be settled on T plus 3. That's why you get the security on T plus 3, but you have to keep your cash by T plus 2 with the broker.
Yes.
To make sure that you honor your obligation. So this is about trade date and settlement date. So in FX market, again, T plus 2, we call it spot. Spot transaction means you settle the transaction after 2 business days in the FX market. If you don't mention the value date specifically, other party of the transaction will assume that it will be a spot-based transaction. But as I mentioned, this spot word mostly used in the FX market to say that the transaction will be settling T plus 2. But say US government bond market, spot mean T plus 1. So basically, what is the regular settlement based on the convention in that market? That is, we can call the spot market. That spot means instantly that you settle the transaction, but it doesn't mean instantly that you do it now. But according to the market norms, market convention, what is the regular settlement date? You settle the transaction on that day. That is called the spot market or the cash market. That means you exchange cash to get your security or the instrument. That's why sometimes we use cash market or the spot market when we compare it with the derivative market. But when it comes to the FX market, again we use the word cash or TOM. That is again to distinguish. So T equals 0, T plus 1, T plus 2. This is in the FX market, we call this value date as spot value date, this one as TOM, and this one as cash. You enter into the transaction and settle the transaction on the same date, we call it cash transaction in FX. You enter into the transaction and settle the transaction tomorrow, we call it as a TOM transaction. You enter into a transaction and agree to settling 2 business days, that is we call spot transaction. So, but the general norm is to settle it on the spot. So, regular settlement. Regular settlement date we call it spot. In FX it's T plus 2. In government bonds in other countries like US, it's T plus 1. Even in Sri Lankan government bonds, it's T plus. Yes.
In foreign currency bond, I have seen the delivery date is a different date. It's almost TOM date, and the settlement is done spot date. Why is that?
What do you mean by delivery date?
Delivery date means cash transferring date. Normally, what we do is we are sending money to our nostro on a day before the settlement date. Then
that is different. So because of, say, it's like this. You have sold dollars.
Yeah.
Okay. You have your nostro accounts in US.
Right.
But you don't have money in that account.
Yeah.
So you have your nostro account. Balance is, say, 0. But you have sold USD 1 million.
Right.
This is Monday. Tuesday, This is the spot date. So on this date, you have to deliver your dollars to the other party. That's the settlement date. But in your nostro balance is 0. You cannot instruct your nostro agent to pay $1 million to your buyer. Why? Your nostro agent will say, how can I deliver? You don't have any balance. He will ask you to bring that balance to 1 million on Tuesday. That's why through a borrowing or somewhere, you keep that 1 million into, or transfer that 1 million from somewhere else to this account on Tuesday. That is what you call delivery date, isn't it?
Yeah. Yeah.
So it's not about nothing to do with your transaction. Your transaction is settled on this date. This is your fund in your account. Your account balance is not sufficient to settle this transaction. This is your fund in your account.
Ah, right. Understood.
Isn't it? That should be.
Yeah.
Whenever you have enough funds, say you had 10 million in this bank account balance, you don't want to do anything. You just send instructions, it will be settled on this date.
Right. Understood, sir. Thank you.
Okay. So this is about trade date and settlement date. Yes.
That means if the nostro account has balance, only a bank can give a same day value for a customer, right?
Yes. Unless you have an agreement with the nostro agent to OD with OD facility. If the agent is agreeing you to withdraw more than the balance or go to a negative balance, then it's possible. On the value date, you should have the sufficient balance in your nostro account. If not, to settle that, you should have an agreement with your nostro agent to get a OD facility. That means that party is lending money to you. Yes.
To clarify the answer, what I think is it's only a control issue, internal control, and the timing difference of the two different countries, I hope.
That is also part of it, yes. In the previous example you are referring, no? T+2 here, T+1 here. To make sure that the transaction settle properly, as a control purpose, you make sure the balance is available by this date. If it is come from the nostro agent, that is to reduce that nostro agent's risk as well. The nostro agent does not want to give you a overdraft facility and fail the settlement. And from your side also, to make sure that you honor your all obligations, you put the control, please make available your funds 1 day in advance. Then you keep it there. But if you are really efficient, no need. Before cut-off time, you have to make available funds at your nostro account on the settlement date. That would be sufficient. But yes, to make it give more assurance, you do this. That's what I said. You have sold only $1 million. Your account balance is $10 million. You don't do anything on this day. You just let it be there. You don't do anything. Anything else? So this is what we call immediate delivery, cash or spot market. So that depends on the market convention. There are markets, the regular settlement falls after 3 business days, where you transfer the total value to the other party. But in the derivative market, delivery may be on a future date. What does it mean by a future date? Even here, after 3 days is in future. No? After 1 day is in future. The future in the derivative market, it doesn't mean that in the general English what is the future, but future means beyond the regular settlement date. Anything beyond regular settlement date, those will be considered as derivative market transaction. Or there may be some transaction, derivative transaction, there's no delivery at all. You don't have to deliver anything, or you don't receive anything. That can happen. We will learn those sort of derivative products when we come to that level. However, there may be transaction without any delivery. Even when there's a delivery, you may not transfer the whole amount, full amount, only a portion of it, or depending on the nature of the derivative contract. So however, the thing is, value or the price that we deliver will be depending on the cash market prices. Cash market means what is the spot market prices of that underlying asset. So you cannot decide what would be the delivery amount today. Most probably delivery amount. There are some you can decide the delivery amount today, but most of the time it will be on the date that you settle the transaction. So again, what is the difference between over-the-counter transaction, over-the-counter market, and the exchange traded market? I think I explained this, but yes, as I mentioned, over-the-counter transactions are just an agreement transaction between 2 parties. There may be a money broker or a broker in between that, but still finally the agreement is between the 2 end parties, where both parties have the obligation to settle the transaction, and the market is less organized. You can customize your details of the transaction, terms of the transaction, depending on the requirement of the 2 parties. But in the exchange trade markets, it's well organized. They have the given products that what you can trade, and with standardized terms. Product is standardized. The quantity, what is the quantity that you can trade? What would be the value dates? What would be the price changes allowed? Everything would be defined by the exchange. Only thing is, the parties to the agreement can decide the price and the quantity that they want to trade. But even that quantity has to be a multiplications of multiples of the minimum quantity given by the exchange. Say, you cannot say I need $1.5 million. If there's no way, say if the exchange has given the quantity should be 1 million or multiples, either you have to do a transaction worth of 1 million or $2 million, not $1.5. You can't do that. You cannot break into small quantities, things like that. So the exchange traded market is well organized, well regulated, and well standardized, and settled through the exchange. There's a process called novation. So a transaction takes place between 2 parties. will break into two parts. And the exchange or the clearinghouse will come to the middle and break the single transaction to two transactions between both parties and the clearinghouse. So therefore, the less settlement risk or the less credit risk is present in the exchange traded markets. So retail markets and wholesale market, as I explained, so no need to explain, but remember here we are in this course mostly we talk about wholesale market. That's why even that transaction date and settlement date concept comes into the picture. In the retail market, it won't happen. You go to the, or you call the bank, or you log into a portal or the bank website, you do the transaction will settle immediately. But in the wholesale market, it's not the way. Behavior may be different. In wholesale market, there are deposits. You can place a deposit, you don't get any certificate. Nothing. That can be done. So, any question? Any questions? No. Okay, then I'll explain what is the role or what sort of things we do in different markets. Basically, capital market, we use that capital market to transfer funds for a longer period. We transfer funds from the lender to the borrower. But in the money market, what do we do? Through that we transfer funds, but mostly we transfer the liquidity, our liquidity. Whenever you get funds, you become liquid, and whenever you give your funds, you become illiquid. So to meet, you need liquidity immediately now. So in the money market, we do that. We lend for short period and we borrow for short period to be liquid. And the currency market, we use currency market to facilitate international trades. That's why we need currency markets. Why do we trade in foreign exchange? To settle the transaction between among Sri Lankan parties, do we need foreign exchange? No. Why do we need foreign exchange? To pay foreign parties or to receive something from foreign parties. When do we need that? To pay foreign parties or receive from foreign parties? That because of international trade. Whatever the exports and imports may be goods and services. We do export and we do imports. To settle those transactions, we need currency market. In the derivative markets, what we do, we transfer the risk. It may be from transferring risk from one party to another party, and meantime, maybe from one form of risk to another form of risk. Maybe market risk to a credit risk, or credit risk to a market risk. Basically, mostly from market risk to credit risk, we do that. Or from party A, from your risk to another party. It's like buying an insurance. Once you buy the insurance, what do? You transfer your risk to the insurance company. Derivative markets we use for that. In the commodity market, we most do trades either directly in commodities or products which are related to commodities. And the major participants of financial markets. So I think this is very straightforward for you. Governments, any country, government plays a major role. There are only few countries, those who have surplus budgets and have less participation in the financial markets. Australia is one of those countries. They have budget surplus, but still they issue government bonds just to keep the yield curve or set up the interest rate structure of the market. Then the other part is central bank. In different countries, the role of the central bank may differ, but basics are there. As a lender of last resort, provision in liquidity or absorb in liquidity that conduct in open market operations. That is the basic function of central bank in the financial market. Not only that's as a participant and as a regulator as well, central banks. But in some countries, remember, central bank does not regulate banks or financial institutions. For that, they have separate entities. But in countries like Sri Lanka, we do both. And other financial institutions, when you say financial institutions, commercial banks, specialized banks, investment banks, leasing companies, finance companies, insurance companies, primary dealers, money brokers, all those. And pension funds. In Sri Lanka, like EPF, ETF, or there are some private firms, they manage their own pension funds. And so those comes under this. And other hedge funds or trust, unit trusts, things like that. And ultimately, individuals like you and me. So the role of the financial institutions is to mobilize funds while reducing the transaction cost. So here what they can do, say, as I mentioned earlier, if you want to lend 1 million rupees to some other party, you have to do an assessment. So first you have to find out a person who requires 1 million rupees for a, say, 3-month period. First you have to find out that person, then you have to assess whether he is capable of paying it back, whether I can trust it. So all those things, if you are to do as an individual, it will be a huge cost. You don't have the expertise. But with the financial institutions, on behalf of you, that institution will do that. They will evaluate the borrower and grant loans, but they may not, financial institution may not take money from you at the same rate. You may have to pay, or you may get a small rate than the borrower is paying, but however, you incur a less cost and less risk because you face the financial institution as your party, not the ultimate borrower. And meantime, through different products, even the lender or the saver give access to funds. Whenever you need, you can withdraw your deposit. So all those facilities are given by financial institutions. And financial instruments that we are going to discuss, first we will divide that into money markets and capital market. But some of these products are not these products. There may be some products which are not listed here, may trade in money markets as well as capital markets, some of the derivative products. But in the money market, cash is the simplest form. And the current account, saving accounts, these things in the retail, not in the wholesale, but still we can consider them as money market products. There are another sort of accounts called call account. It is like in between fixed deposit and a saving. Now even the nature of the savings is changing, so savings are becoming like call accounts. And the fixed term deposits, this term deposits and call account can appear in both retail and wholesale market. Treasury bills, commercial papers, certificate of deposits, repos, and reverse repo transactions. So treasury bills, you know what it is. Commercial papers, I just explained. Certificate of deposit, which is not, I haven't seen this in Sri Lanka, But this is a sort of fixed deposit, but in a fixed deposit, you cannot transfer the ownership. In the certificate of deposit, you can transfer the ownership. So,
Excuse me, sir. If you don't,
yes.
Excuse me, sir. If you don't mind, could you please explain commercial papers again?
Commercial papers, it's a short-term borrowing or the short-term security issued by a commercial entity or a corporate. Like say treasury bill, you know what is a treasury bill? Treasury bill is a security issued by the government to borrow funds for a short period, less than 1 year period. The same thing is done by the corporates, then it is called a commercial paper. So,
sir, then that corporate should listed in stock exchange.
In Sri Lankan context, yes.
Otherwise, they can't, no?
Yes.
Right.
Otherwise, yes, they can do like sort of like a private placement or something like that. That's they borrow from somebody. That then you may not call it as a commercial paper, yes. But commercial paper is again a tradable instrument used by corporates to raise funds for a short period, less than 1 year. So to become it tradable, it has to be listed in the stock exchange in the Sri Lanka.
Then is it security for commercial papers compared to a bond? As I know, bond is the most secured
Yes.
instrument compared to.
You mean government bonds?
Yeah, government bonds.
Yes, government
Compared
bonds. You said it's more the secured because, as I explained, that we believe that government would not default. They have the ability to pay or the print money, but corporates, they don't have that facility. Yes, commercial papers are much riskier than government bonds or the government bills. That's true, but there's no security. So we call this is just a certificate or a piece of paper. If it
agreement between corporate and
between corporate and lender. True.
Lender.
Yes. Yes. But if you really want, you can do some modification that like you can ring fence some of the assets. So in any event, the lenders have the claim on that asset. Things like that to improve the credit quality of that commercial paper or the debenture, that can be done.
Right. Okay.
So whereas this certificate of commercial papers are traded, and from where this is originated? Is it in CSE?
Origination is from the borrower, the firm. Whoever who wants to borrow, they have to initiate it, but they have to list it in the CSE.
Okay, so thank you very much.
Okay. So certificate of deposit is a product that like a fixed term deposit, but you can transfer the ownership for another party.
When you say commercial paper, is it same as a corporate bond?
No, this what do you mean same as corporate bonds? Yes, in a way yes, in a way no. In the corporate because the bond and the bill, there's a difference.
Okay.
Yeah, that difference is there.
Okay, but
this would be like a treasury bill. That means no coupon, no coupon.
Okay.
You pay something today, you get the maturity proceed on the maturity date. No interim cash flows.
So if you say
it's a discounted product. In
bond, that's the same thing.
In the treasury bond and the debentures,
okay,
nature is there are coupon payments and things like that. But the difference here is treasury bills are issued by the government, commercial papers are issued by the corporate. That's the difference.
Okay.
But the product is same. Economically, or the functionally, economically same. The risk is different, and the issue is different. So we'll discuss more on repo and reverse repos later. I am not going to discuss certificate of deposits because it's not available in the Sri Lankan market. But if you really need, we can do that as well. In the capital market, is that okay if I take few more minutes to finish this? Then next week we can start with a new session, new topic. Is it okay?
Oh, okay, so okay.
Yeah, sure.
So I don't think there are too many difficult things in the rest of the presentation. So the capital market, that's the debt, basically debt market where you trade treasury bonds, corporate bonds. Again, corporate bonds or the debentures both are same, but in different countries we use different words. And the floating rate notes is again a sort of a bond, but the coupon rate vary with the time. We'll discuss these when it comes to fixed income securities topic. Convertible bonds, that's issued as a bond, but after some time, if you wish, you can convert it into shares of that particular issuing firm. Index linked bonds, again, you can see the word bonds is there, but again the interest payments are linked to a, say, maybe an inflation index or something like that. Asset-backed securities, that is again like financial institutions, banks or other financial institutions, they have some assets. They pool those assets together, and based on the cash flow generated through that assets, they issue bonds. That is asset-backed securities. Mortgage-backed securities specify that set of assets into set of mortgage. So in general, these both asset-backed securities and mortgage-backed securities, we can call it as securitization or securitized products. We'll discuss those in detail later. However, all these are just list of financial instruments that we used in capital market. So be ready. We are going to discuss in detail about at least treasury bills, commercial papers. Once we do treasury bills, it's almost same thing in economic terms about the commercial papers. Only the issuer is different and the risk of that issue. And repo and reverse repos, government bonds. Once you learn government bonds, corporate bonds and debentures, more or less the same. But floating rate notes, what are the difference between fixed rate bonds and floating rate bonds, and securitized products. So we are going to discuss this in coming weeks. So in the capital market, we trade debt side, these are the products. In the equity side, common stock, preferred stocks and warrants. As I mentioned, in this course, we are not going to focus or discuss on these products, equity market products. In the currency market, it's just currency, but depending on the settlement date, we classify them, whether it's a spot transaction or a term transaction or a cash transaction or a forward transaction. I believe now you can identify what does it mean by term, what does it mean by term, what does it mean by cash and forward. Is it clear? Spot means the settlement date falls after 2 business days from the transaction date or the trade date. Term is 1 day after the settlement falls, 1 day after the transaction date. Cash means the trade date itself you do the settlement. Forward means you settle the transaction any day agreed by both parties beyond the spot date. Then the derivative markets. So these are the derivative products. Now I'm not going to explain these products because we'll discuss these things later. But get ready that no, these are derivative products, at least the name. Then the financial market regulators, as I explained earlier, there are regulators to build the investor confidence, to avoid some misconducts or malpractices happening in the market. Central banks, securities exchange commissions, insurance boards, so financial supervisory authorities. In some countries, central bank does not regulate banks and financial institutions. It is done by financial supervisory authorities. And I mentioned the exchange. There may be exchange even to monitor those, the commodity futures and exchange commissions, and they are in different formats in different countries. And there are some other participants, those who provide services, related services, exchanges. In a way, you can consider them as providing a service to the financial market. Brokers, they do provide service, because brokers, there are two different set of brokers. Some are just provide the brokering service. They don't buy or sell or make investment for themselves. They don't do that. They do the transaction in the market just for on behalf of their customers. That's it. So they provide just a service. And credit rating agencies, they help us to evaluate the credit risk of our borrowers, or even the issuers getting an credit rating will bring down their cost. And credit bureaus like our CRIB, they do assessment of credits, and other information providers, those who provide news and forecasts, or gather information, pool them and come up with different sort of forecast and predictions. Bloomberg, Reuters, or Financial Times, whatever it is. And the trading platform providers, again, there are a lot of trading platforms available in the market where you can trade through that platform, electronic media. Bloomberg is at the front, Reuters, now they rename it as Refinitiv. And even individual banks, they have their own portals to trade. So all those are work behind the screen of the financial market, providing services. So that's it about the introduction of the financial market. The reason I gave you this, now you might have realized. So you know things about banking and the practices of banking in the probably in the retail market, or how do you handle the individual customers, even corporates. But the way it's happening in the treasury and the wholesale market may be slightly different. Now you have to switch that mode at least when you come to this class. So I think this background knowledge is enough for you to move forward in the future classes. So any questions or any comments?
So what will be the next tute about?
Either we can start with money markets, or do calculation about present value or present value and future value. I think would be better to do that sort of future value, present value, what is discounting, what is interest rate, and things like that, because in the money market also we have to do those sort of calculations. I think better we'll start with that some sort of calculation.
Okay, sir.
Hello, sir.
Yes.
Just a small request. When we can get the next tute?
By probably next Tuesday or Wednesday or Thursday.
Wednesday or Thursday?
Yes.
Okay. Can you get us an exact date, sir? So we can download it and get a printout.
Then you check it Friday. Definitely you will get it Friday. Yes.
Okay. Thank you.
Okay. I'll try to upload as much as early possible, or even for 2-3 weeks forward, whatever we required in the future.
Yeah, thank you very much for that, sir.
Okay. Anything else? So if you don't have any questions, so it's late, 15 minutes, that's the time that we missed at the beginning. Sorry about it. So, okay, then we'll stop and see you next week.